Good morning. Once again, I have the opportunity to have a conversation with Senior Vice President Sebastian Rivera of Intercoastal Mortgage. And this time, I went ahead again, as we've done in the last two sessions, and looked up questions that buyers and sellers are putting on the internet in the last couple of weeks. And this time, I also went ahead and focused primarily in the greater Metro DC area. As we all know, there's a significant number of federal employees in this area, and we wanted to talk a little bit about the consequences of, losing their jobs, Doge, etc. So I'm gonna, and I've also split it up into two, which is two sections. The second section will be a little bit towards, a higher income bracket, higher value property, since in DC, in the greater DC area, that is something that is extremely common. So anyway, without further ado, Sebastian, good morning.
Good morning, Adrian. Thank you for having me.
So I'll start with question number one. What specific strategies are available for buyers to lower their effective interest rate?
I'd say the most common strategy right now are going back towards ARM products. ARM products are 30-year term loans with a shorter duration of a fixed rate period. Most common ones are 5-year, 7-year, and 10-year ARMs. So one of the more effective strategies right now is people opting to go for these lower price mortgages in substitute for the higher ones. And eventually, when rates drop and come down, they'll be refinancing into the fixed rates. That's, I'd say, a primary strategy besides buying points, of course.
Of course, when you talk about the ARM strategy, if interest rates were to drop, can they
Mhm.
refinance, say, a year in?
Yeah, anytime they want, there's no restrictions on them. On most arms, there's no restrictions, unless you have a specialty portfolio arm, which I would always recommend asking your loan officer. But most of them, no restrictions. You can refinance the very next day if you really wanted to.
Okay. Takes me to number two. Will my mortgage rate be affected if I need to return to office versus to continue to do remote work? And this is like, I'm thinking about clients that moved to Front Royal and Winchester and places like that during COVID, and now are stuck with, commuting back into the city. And I use transportation as an example. I have been shocked to see that on 66, there are days where you pay $50 a day for one-way commuting. And so that can turn into a hefty expense. And I just use that as an example. So what are your thoughts?
I got tagged at $62 one time. Never
Wow.
again. There's no problem with that. It's a common question. As long as we can have fully remote employees. For example, I have an employee that lives in Florida that works for a Northern Virginia company, and they live their full-time primary residence. As long as we have some sort of documentation from their company stipulating that they are able to work remotely, it's no problem. No problem at all. All we need to verify is that they're still working for the company. And if it's a remote position, they can live anywhere around the US without affecting their rate.
Okay, so what kind of expenses do you think? I just want to expand a little bit on this question. What kind of expenses would you be looking for that might affect the rates?
Expenses in what sense?
In the sense of I went out and bought a car.
Oh,
I'm spending, a lot of money on transportation. What would you gauge as something outside the norm?
well, what we use are things that go on the credit report. For example, a car loan, an installment loan, student loans, credit cards, anything that impacts your credit report, that's things we use. Things outside of the credit report, such as childcare expenses, we would only count them in certain situations like a VA loan. But any extraneous costs, we don't typically take into account unless there's a mitigating factor for us to do so. But the rule of thumb is if it's on your credit report, we're going to use it. And if you're a veteran and you have childcare expenses, we're also going to use it. Other things that would come up that aren't on the credit report would be in divorce situations, alimony, child support, those always come up as well.
Okay. Okay, very well. Can I get a mortgage forbearance or deferment if I've been laid off from a federal job?
Yes, you can. There are laws that protect consumers, that protect mortgage as well. Depending on which state you're in, these can change a little bit, but overall, there are protections in case you're laid off. I always recommend going to your servicer's website or the originator's website to figure out what those are. But yes, there are multiple protections in place.
Okay, that's very good to know, especially in this area. Um, what credit score do I actually need for DC specific programs?
For the first time buyer programs, typically a 620 is what we look for, as low as 620, 640 to get somewhat decent rate. To have access to the better scores, you definitely want 720 plus. But the lowest program we have available right now in DC is 620.
Wow,
Unless you consider an FHA loan with 10% down payment, you can go as low as 580, but that's much tougher to
that's
go
a
through.
stretch. That is a
That's a
stretch.
case, those are case by case, and the underwriting on those programs is much more strict.
Okay. So I'm going to focus now on a more upscale market questions that I found on the internet. And can I get 10% down payment financing on a $2 to $3 million property? And what cash reserves and debt to income ratio do I need for a jumbo loan above 2 million?
So yes and no. The easy answer is yes, because there's always somebody that's going to be giving you money. No, in the sense that most lenders on a 2 million loan will require a minimum of 20% down. Now, some of the ones that I have seen that do allow it, Morgan Stanley, when you do a cross collateral and you pledge your own assets, and this is somebody that has, for example, 5 million in their bank account, they pledge part of their assets, they do 10% down payment, and big brokerage homes or big banks will definitely want to keep your business and facilitate the financing. But this is reserved for people who have plenty of assets and larger portfolios. For your typical average Joe, no, you won't be able to do 10% down on a $2 million loan unless you
Can you,
pay an extraordinary interest rate.
can you expand on what cross collateral means?
Grabbing assets from one side and putting them on the other side. As simple as that, or asset pledging. You have a couple million in your bank account in stocks. Morgan Stanley wants you to stay there. And what they'll do is typically lend you against whatever you have and collateralize your stocks against the house.
Okay.
So when you have assets, you have more options for sure. But if, like I said, you're average Joe off the street and you don't have this amount of assets, getting 10% down is going to be either ludicrously expensive or just unavailable.
And I thought of something as you were answering that question. Is there
Mhm.
a percentage when soliciting a mortgage, is there a percentage down payment that would forego the need for an appraisal? So let's just say that, some of my clients that are in those spending brackets, two, three, $5 million, they put down 75% cash and they just want a mortgage for other fiscal reasons. Um, would you forego an appraisal if that happened or not?
I cannot, but big banks may be able to do so. I mean, it's a common sense decision. If you're buying a $5 million house, putting 75% down, the bank may want something. They may do something called a desktop appraisal. On
Which
these
is what?
larger, it's just automated online. So an appraiser doesn't have to go out physically. They simply go online, type in the address, and they get the result back. Boom. As long as it's within the value, a lot of HELOCs are done that way as well. As long as it's within the range and it makes sense, they move forward. In terms of the reserves, depending on the down payment and loan amount, it can vary anywhere from 6 months. I've seen as much as 36 months.
Okay.
One reserve, a reserve is 1 month of your mortgage payment. So if your mortgage payment is, I don't know, call it $10,000 a month and you need 6 months, 60,000 in reserves somewhere. Some
Okay.
investors and some banks will limit if you can have it in 401k or retirement. Others want it in stock, cash. So it just depends. And the ratios that you were looking for, the DTIs, some banks on these jumbo loans will cap you at 40%, some at 43, some at 45, and the ones with the higher rate up to 50.
Wow.
So it just
Okay.
depends.
Very well. So high-earning federal employees and contractors purchasing 1.5 million plus properties want to know how lenders will view their employment stability, especially if they are political appointees or face potential Doge-related layoffs, or is it all about the number?
All about the numbers. We are not allowed to discriminate by employment, by sex, religion, race, employment being one of those. And if you work for Doge, if you work for either party, if you work as a political appointee, as long as the numbers work,
Mhm.
then we're okay. Now, you touched on an important part there. How about furloughs? This is a big question that everybody has. We try to do common sense lending. In some cases, even though the
Right.
employees are furloughed, we are able to continue with financing, especially with a portfolio loan. If we have a federal employee, we actually had this recently, that's been 20 years a federal employee, but is getting no pay right now and has to close, then a portfolio loan makes sense. It's just common sense lending. But to meet Fannie Freddie guidelines, there are other stipulations that have to be met. And if they're not met, we may not be able to close with a Fannie Freddie product or with a specific bank. So it's sometimes we just go back to the portfolio loan and just common sense lending. It's not ideal. It's a band-aid, but it gets the job done.
Okay. Okay. So last but not least, luxury clients aren't asking, can I afford this? They're asking, what's the most strategic way to finance this? They
That's
they want
exactly right.
sophisticated mortgage solutions that preserve liquidity, provide tax advantages, and align their broader wealth management strategies. Can you provide some examples?
Um, Cross collateralization, taking assets from one side to another. You have asset based lending, which is just based on the assets. I know somebody recently, a crypto millionaire, that has a tremendous amount of assets in crypto, but no income all day long as a trader. So, based on that, a loan was able to be provided. We could do pledged assets as well, like the example from Morgan Stanley. There's some multinationals that I know that are also, they do some creative financing with trust ownerships, and
Okay.
they're able to get the loans that way. I mean, when you have money and when you have assets, there are a tremendous amount of creative ways to get this financed.
It's good to know.
This this is when you need a good wealth advisor and a fantastic accountant.
Yeah. Right, exactly. They can walk you through tax advantages, disadvantages, etc., how to handle your money. So you need both a good financial planner and a good accountant. I totally agree with you. And I think most
Yep.
people in that income bracket do have. I'm assuming that
Oh,
they
for sure.
really do. You know, that's
And
why they have what they have.
And trusts are a big one. I've seen some very creative movement of monies through trusts, and it's just they follow the tax code, they do everything by the book, but you need to have assets for that.
Right. Do you see a lot of crypto transactions?
I see some. I don't see a lot of it, but I do see some. And we're starting to accept crypto as assets for the down payment. It's the documentation of crypto is nothing short of a nightmare, especially for active traders. But
Right.
yes, we are able to.
Yeah, because it's like a minute-to-minute transaction. At least it
And
is in real estate.
Correct. And sometimes you have people with bots that have over 1,000 transactions per day.
Mhm.
So needless to say, it's challenging. As a lender to document it and make sure we meet all of the Fannie Mae, Freddie Mac guidelines,
Right.
it's challenging. So
Okay.
if there's an account with minimal movement and I can see the money going in, growing, and then money going out, it's okay. But those micro transactions right now, where lenders are not equipped to handle it yet.
Okay. So I have an additional question that just came to
Mhm.
mind. I'll be doing I'm doing a course on AI for realtors this coming Thursday. So I just thought of asking you, what do you see in 2026 as the impact of AI in your industry?
In our industry, products. So AI is getting to the point, Freddie Mac just released this. We have AUS, which is the automated underwriting system. You have Fannie Mae and Freddie Mac, DU and LP. Freddie Mac's Loan Prospector LP now has integrated AI where it tells you the decision and what you would need to do if you don't get the decision accepted, if the loan gets rejected, what you would need to do to get it accepted. That is groundbreaking in our industry. So now it's not just a matter of, oh my gosh, can the loan please pass, please pass? Now it's the system actually telling us if you add an additional 6 months of reserves, the loan will go through. That is huge. So on
Absolutely.
these on these underwriting systems, you can't just keep on running and running and running and hoping it goes through. Eventually, you get flagged and you get in trouble for it. The loan works or it doesn't work. But with this system, now we know what to do. We can get a gift for $15,000 and make the loan work. We can do something else. We can pay off a credit card to get the credit score up, and then the loan works. AI is going to help us get loans proved more efficiently and knowing what the back end steps are going to be to get it through. That
A
is
lot more
huge.
coaching to your client. a lot more coaching to your client instead of as a yes or a no. It's like this is what you need to do in the future if you want to correct your credit, if you want to do a number of things.
And it's strategic coaching because we've always done coaching to the clients. Hey, if you do this, and we over pad the coaching. Hey, well, you need to pay off these 5 things, and we need to get your credit score here and a gift for this. But now we know exactly, we can pinpoint exactly what it is and go straight for it. So it's going to make loan officers more efficient in telling our clients what we need exactly to get done.
Do you see
That's huge
any
for us.
Do you see, in addition to that, any other future changes? For example, in one of the key functions of any mortgage lender, which is underwriting. Do you see any major changes coming to the
We
underwriting
do.
process?
We do. So AI is starting, there's multiple companies out there putting out pilots of underwriting where they fully underwrite the files. And we're starting with the easiest ones, the government employees, the straight W-2s, no overtimes, to get AI trained into it. And slowly but surely, you're going to see AI assisting underwriters, and it'll help an underwriter do their job more efficiently and faster. Less errors, more AI training, and it's just going to make the process quicker
Okay, that's good to know. So
and more error-free.
we got a little techie in here, and we'll keep everybody posted as changes come about. Once again, Sebastian, I so appreciate your answers, your intake, your experience, and I'm sure that there's a lot of people out there that would benefit from your responses. Thank you, and I'll see you on the next one.
See you soon.